Today we're going to talk about how we backtest. We backtest millions of trades every single week. It helps us to trade over 30,000 SPX 0 DTEs a year, 30,000 a year. So let's get into it and take a look at what we do so you can see how we do it. Alrighty, so here we go. As you can see, we do this presentation will just be about how we backtest. All right, so let's talk about the planning and setup. When we start off every single week, we look at what we have in each fund in the net liquidation value. We're going to take off 30% for our NQ strategy, at least in the funds that I manage. I manage short puts in NQ that I put on every single week, almost daily, and I allocate 30% for that. Then I hold another 10 to 20% off to the side for safety, leaving me 50% for the SPX. That gives me kind of a balanced trading approach, and in the event that we have a severe drop in the market, either during market hours or after market hours, I've got plenty of extra money that I can put into the short put NQs because I like to buy on the dip. So let's take a look at the next one here. So our strategy framework, we actually trade about 20 different strategies in our fund, but today I'm just going to go over the MEC strategy to show you basically how we do it. So we're going to do multiple entry iron condors. We're going to do exponential moving averages. We'll use opening range breakouts, and pretty much these are all options-based volatility strategies. When I was a professional gambler, I knew that 80% of the people would bet on the favorite, and 80% of the people would bet on the over. And so what I always did, I bet on the underdog and I bet on the under. And that gave me a mathematical advantage because we all know from our old economics classes that there's a big supply of a big bunch of buyers on one side, then the price is going to go up inordinately high. And that's what would happen. So that's why I like selling puts. That's why I like selling calls a little bit, not quite as much. And that's why I liked always betting on the money line dog and always on the under. The same idea, we have a mathematical advantage. In this channel, our motto is math makes money. Bet with your head, not with your heart. You cannot predict what the market's going to do. So let's just go ahead and bet the math. That's what really works. All right, let's go down to the next one. So here is a typical back test that we put on. You're going to see exactly what it is that we do. This is a weekly test. This is an actual test that we run for $108.85 premium on the put side and $150 wing. We do $185, $1.85 on the call side, and again 150 wide wings. These are going to be 0 DTE. This is all, by the way, in Options Omega. We love Options Omega. Like I said, we trade about 125 trades a day, 30,000 trades a year in Options Omega. If you want to sign up for them, I do have a 50% off code in the comments below, and they give me $15 for everybody that signs up, and I give that to the Humane Society for the dogs. So if you want to help the dogs out, join Options Omega. So again, here we do a lot of different things, and suffice it to say that there is a complete, very, very robust backtesting system. We can backtest every single minute of every single day, which we do. And when you do that, you know there's 390 minutes in a trading day, 6.5 hours. And so if we look back 6 months, on a monthly basis, we'll go back 3 months, 6 months, 9 months, 12 months, 18 months, 24 months, and 36 months. But it's too much to do. It's too many millions of backtests to do every single week. So you can see here that it's still about 80,000 trades that we're going to be doing for every single test. Now I want you to remember that 82,276, that's how many trades we're backtesting for each one of these types of combinations, right? And you can see that this has got a crazy max drawdown of 109%, and it's got a compound annual growth rate of 4,600%, which is great, MR ratio of 42, but that's not really realistic. And when we run these, we start the capital at $100,000 for each 1 minute of trading for that 180 days, which only is going to go back 125 trading days, right? There's only 250 trading days in a year, so it's only going back 6 months. It's only going to go back 125 trades. Whoopsie daisy. Let's put that back where we found it. We don't want to get in trouble. All right, let's go to the next slide. So we simulate every minute of trading with about 82,000 trades. As I said, we do variable isolation testing. So we independently test variables like premium level, stop loss. We look at entry time, of course. And so what we're going to be doing is you think about all these combinations. So we're going to do, for premiums, we're going to look at 95 cents, $1, $1.25, $1.50, $1.75, keep stepping that up all the way to $5. And then for stop losses, we're going to start at 50%. We're going to step our way up to 700%. So you got a combination of entry times, 390 of them. You have, say, 10 or 12 premium sets that you're going to look at. And then you have 10 or 12 stop loss sets. And then just to make it a little more fun, because some of you have smaller accounts, you like us to do the lower wing width. We do 150 wide wings, because basically we just use the wings as a buying power reduction methodology. It costs us a nickel for each trade. But if you don't have enough buying power, you're going to have to go for more, narrower wings. And so you're going to have to run other combinations, 25 wide, 50 wide, 75 wide, 100 wide, whatever it might be. And so that's going to give you, for each one of those, remember, 82,000, whatever it was, 276, for those of you that can remember that stuff. And so you're going to get into millions, and very quickly you'll get into millions and millions and millions of back tests. So again, one of my favorite numbers here is that 82,000. You got to keep that in mind when you're running all these back tests. Now, when you run the back tests, what you're going to end up getting here is a trade log. And so the trade log is going to show you for every single minute of every single day. It's running both the put credit spread and a call credit spread. And notice how Option Omega conveniently breaks that out for you, because each one of them has a different stop loss. So the way we do it is, if the short leg gets to 95%, that's the stop. It's not for the spread, and it's not for all four of them. It's not for 4, it's not for 2, it's just for 1. It's just on the short leg. Now, on the long legs, you can either close those manually, you can let them go. A lot of them are just for a nickel. But if you've got shorter wing widths, if you're a smaller account, and by the way, don't get me started on why I think that the small accounts get hosed over on all this trading. If you have a small account, I guarantee you're going to get hosed compared to the large account. Large accounts have a huge advantage till you get up to about $20 million. And then actually the real sweet spot is that $1 million to $20 million range. If you're outside that range, it's much more difficult. You still make money, much more difficult. If you're under 30,000, I don't think there's any way you can make money doing this. It's very, very, you might for a short time. It's very risky. You're better off just put your money in SPX until you get up to 30 grand. Okay, so however though, what you're going to see here is that the put credit spread, the call credit spread are put on separately, and they're also taken off separately. So you can see, like here, this one expired in a profit, this one was a stop loss. And that's great for what Options Omega does. We're doing that minute by minute. We're doing that for 125 days. We all know how many? 82,276 just for this one test. So then, let's go to the next one. And so what are the tools and metrics that we use? Well, that shouldn't be in there. Oh, we're going the wrong way, that's why. Let's go this way. So, the tools and metrics. We were talking about the tools and metrics. The tools of the trade, we use, our primary trading platform is Options Omega. So yes, we do the back testing and we do the trading in Options Omega. So I want you to understand that. We use Python and AI to take the data that we get from Options Omega, those trade logs, and we put it in AI. We run a bunch of Python scripts. We massage it. We look for key relevant metrics that we drive, Sharpe ratios. There's all kinds of things we look at, CalMAR, the MAR ratio, the KGAR, the MDD, and I'll show you about those in just a second. And we use AI as support, and we use that to give us a trading edge, actually, is what it does. So this is AI. This is my actual AI for this report, for the $1.85 trade log. This is the one I ran on November 11th. We're using $100,000 and a 95% stop loss. This one actually was for the 50 wide, so this one would have been for the would have been for the six trades a day challenge. Let's see if we can get that there. All right, let's go to the next one. So this is what's put out by AI. AI is going to put out a spreadsheet of listing from, spreadsheet, then we put it into a table. And the first thing we're going to look at is the KGAR, the compound annual growth rate. Obviously, you're looking for a good KGAR. And this is why I got circled here. And so we put this into an Excel spreadsheet. We run a bunch of pivot tables on it. We sort the table. We like to see what is the best, what's producing the best rate of return. But that's not all that we do, because that's not really as important as some other things. It's important, don't get me wrong, it's important, but it's not as important as some other things. So the next one we're going to take a look at is the MAR ratio. Excuse me, we're not going to do MAR ratio. Next one we're going to look at is max drawdown. Okay, so max drawdown. If I was really a robot, I would not care about max drawdown unless it got down below 50% or above 50%, because I would just look for the maximum rate of return over the next 180 days. But I'm a human being. I got a wife and kids, grandkids, and they don't want to hear that grandpa's down 20% in one day. So we look at what is the max drawdown. And remember, max drawdown is not an individual day, but it's a string of days. So the way it looks is, it looks at you're going up and up and up, and then from any point it starts at, what's the max that it goes down. So it might be the first date, if you went down 20%, and then you went up here and went down 18, and you went up here and you went down only 10, but it was more money because you'd grown up bigger. It looks at percentage-wise, what is the largest drawdown you're going to have. That's the max drawdown. Me personally, I don't like it to be over 10%. And when I'm looking at 6 months, I like it to be under 5%. Because we're doing dailies, also I'm worried about sequential risk. That is the risk that you might get 8 or 10 in a row. That's another thing we do. We have AI look at our sequential risk. And so we like to keep all those things to a minimum. And that's important when you're deciding what is the quote-unquote best trades for the day, or for the week. So next, we're going to take a look at the MAR ratio. That's really our top-line decision rule. And that takes into effect the KGAR and the MDD. In addition, we have that taking into our sequential risk as we resort it after we bring it out of this table. So now we've done that for all 82,000 trades. We've done it then for the millions we put in there. And now these are the metrics that matter. As I've talked to you about most of these, you can come back later and look at these. But it's pretty straightforward. We are looking for the quote-unquote best trades, and there's a lot that goes into making that determination. Now, how do you select them? Well, we rank them by the AI, of course. We use a stoplight categorization. So, like a stoplight, we don't just go in and say, okay, we're going to take, normally I like to take the top 100, 125 trades of the week. And what I'll do is, I don't just put them all on as one lots or as what we call a 1X. So if you have a larger fund, they might be 10 lots for every one. So we use a stoplight. So the green, and we do it backwards. So the green lights are on top, and those are the ones that will be the most. Those will be the 3s, and then the yellow lights will be the 2s, and the pinks will be the 1s. And I typically break it up into 33, 33, 33. However, once in a while you see one, say the MAR ratio is normally going to run between 20 and 10 is where I'm going to be putting those 125 trades. But once in a while you get a MAR ratio outlier, a 25, 27, even we had a 32 once. And so on those, we like to really hit those hard, and we'll get those a 5 or a 6X on those particular ones. So it's kind of a weighted gambling, if you will. And at least that's the theory. So what we do now is we want to turn this math into motion. So when we're looking at hundreds of trade strategies. We've got 80% of the strategies are, remember, 80% of strategies are carried forward week to week. In other words, you're only cutting off 7 days at the beginning, and because we're always going back 180 days, we're cutting back 7 days at the beginning, and we're adding 7 days at the end. So it's, about 80% of them are not going to change. It's going to be the same ones. Now that they might go from a green light to a yellow light or something like that, but basically they're going to be a lot of them are going to be the same. But still, it's a lot of trades you got to deal with every single week. So let's go to the next one here. Okay, adaptation. So we also do dynamic market timing. So we are always looking for trying to get in as many times as we can per day without overlapping. So there are some things you have to take in. Again, if I could get perfect execution, I would go in the CBOE, the Chicago Board of Exchange. What they do is they break down every second into 10,000 segments, so you have 10,000 milliseconds. So if you could, the perfect strategy would be going every millisecond, but you can't do that. You can't execute it. It actually takes about 6 seconds if you're not on an exchange or at a broker for you to have your robot enter a trade. It goes in to your broker. Then if you change or cancel that trade, you send in the cancellation. It takes for them to then cancel it, and then you send back the revised trade. And if you do it faster than 6 seconds, sometimes it works, sometimes it doesn't. But the whole system that we trade on with multiple entry iron condors especially is based on the premise that you have a put credit spread and a call credit spread going on at the same time, and they're coming off when it hits the 95% stop loss or whatever your stop loss might be. And so you don't want to have missed opportunities and no fills. You want to be sure you're getting fills on both sides. You don't want to be filled on one side, not filled on the other. So we like to set that about 6 seconds, 5-6 seconds apart, sometimes as much as 7. Also, you want to make sure that you don't put a long and a short on the same strike, because what's going to happen is when we're doing 125 trades a day, especially as you get down to the end of the day, there aren't that many strikes that are available, right? They're by $5, and say you're putting on 10 of them, and you put it on 100, and now you're down to the last end of the day, and some of them are taken, and the market's moved, so some of the longs are at the money. And so what you don't want to do is you don't want to overlap them, because the trade will not be accepted. A broker won't accept a trade. If you already have a short, they won't accept a long. If you already have a long, they won't accept a short. So you got to be sure you don't have any overcrowding. And also, when you come into overcrowding, you want to make sure that, like, 12:56 right now is a very popular time, right? It used to be 11:01, now it's 12:06. We see the clumping and the grouping. And again, though we call them little islands, you don't want to put everything into one island. You want to just be in 3 islands. You want to separate it, because again, the whole premise is, as the market goes up and down, we're moving with the market up and down. And the idea being that the market may move a lot in one direction here, and may move a lot in this direction here, but we're moving all the time, and so we're always trying to stay outside of it. We're outside of the market constantly, and that's the theory of how these work. All right, so the other thing we do, and it's really critical, a lot of people just stop at the back test. So they do the back testing, they put the trades on, and then they just sit back and say, woohoo, we made $80,000 this month. And check out our videos. I think Maria posted a video, we made 80-some thousand we posted per million. So per million in the fund, we made 80,000 in October, I think around 70,000 in November. So it's pretty good. It's really good, actually. That's not probably sustainable. In the 6 trades a day challenge, I think we're up about 23% in 60 days, so about 158%. That's absolutely not sustainable. That will average out as we go. It'll average right around 52 to 74%. That's where it will end up, probably. That's looks like what the math is like. So we then take a look at what are our actual results, and we look back to see how we did compared to what we predicted. And the reason we do that is manyfold, but first of all, we want to make sure that the darn thing is entered correctly, right? There's lots of opportunity for entry error here. There's entry error when you do the entry of the back test. There's entry error because you forget to do a back test, or you do a back test twice. There's entry error when you're in AI, and AI doesn't calculate it right, and AI sometimes does not calculate it right. We have to we do verification tests on all of our AI managed data. So that's really, really critical. Next, you have to do it when you're building your own, those tables I showed you. You want to make sure that those are built correctly. So there's human error that could go into that. So what you do is you take your results and you look back and you say, well, was it within an expected range of outcomes, or was it a severe outlier? If it's a severe outlier, you got to really take a hard look at it. I mean, I know today we were doing our forward testing, and we saw that, over the weekend rather, we saw that there was 1214 that was being entered at 1221. It just had been entered incorrectly. And so, and just on the put side, we're like, hey, the calls were there, but where are the puts? And the puts were entered 7 minutes earlier. So you have to really be sure that you're verifying exactly what you're doing, because lots of mistakes can be made. You want to make sure a stop loss is in there. I didn't put in a stop loss one time. Instead of putting in a negative on the put side, I put in a positive. Cost me $72,000 in one day because there was no stop loss, and it went against it. So you got to be really careful and make sure that everything is entered correctly. So a little bit of a scare factor there. But if it is, it's great. It's great. So let's look at our core principle. We do algorithm. We do math trading. Let's leave it at that. It's hard for me to pronounce. Math over emotion. Math makes money. It is repeatable, scalable, small trades. That's what we're after. Think of my gambling story, right? I always bet on the money line dog because everyone else bet on the over. I bet on the under because I bet on the money line dog. Everyone bet on the favorite. I bet on the under because everyone bet on the over. Now, in multiple entry iron condor, God bless the internet and YouTube and people like me that make these YouTube channels. There's people that go on and say, oh, these are the bets you ought to make this week. I do it 6 trades a day, right? I mean, it's there. It's there. Why not? It works. When it works, it's great. So now what you have is think of the market as an amoeba, right? And they're all looking for the secret trade. And most people don't want to do the work, right? They're lazy. They're not like you. If you're stuck with me all the way through this video, you want to do the work. So this amoeba here is that, oh, the easy money is over here. So it moves over here, right? The easy money. And it starts chomp, chomp, chomp. Well, it chomp, chomp, chomp. All of a sudden, these times, it's 11:06. It used to be one of the best times, no longer a great time, right? Turns out now 15:51 is. Whoa, they start, and everyone's, 15:51 is terrible. Yeah, it was 3 weeks ago, 6 weeks ago. Now all of a sudden 15:51 is great. Oh, that amoeba starts moving. It moves over 15:51. What do they leave? They leave the 11:51, some stragglers, but now 12:56 is great. So now we are going to 12:56, and but understand, the amoeba is coming. It's coming. The herd is coming. The horde, if you will. The barbarians are soon going to be the barbarians at the gate, as they say. They're coming. And our game is to stay out in front of them. So we want to have iterative, I don't know who wrote this thing, but I cannot read some of these words. That we want improvement, constant improvement, okay? That's what we want. And that's the name of the game. It's not just knowing the math, right? You have to understand the math, and you have to be able to execute on the math. You have to execute on the plan, but then you have to understand every trade has a season. It has a spring where it's great, then everybody hears about it. It's a summer, and all the amoebas come, and that moves it into a winter. It's no good anymore, and you got to go to another one. Having said that, let's think about how we stay out in front of them, right? So, math makes money. This is the operational cycle loop that I was talking about. Backtest, execute, review, repeat to optimize the strategies. It's not just MEX. It's also EMAs. We love those. Double calendars are great. Opening range breakouts. Don't forget your reverse iron condors. They are wonderful. Maria's favorite is the naked put and the wheel strategy. I love that as well. Those are great. And they're a little bit more difficult on SPX, but they're still things you want to put into your portfolio so that you have some diversity across what you're doing. Everything we do is data driven. We don't do it based on some monkey telling us, analysts telling things are going to be good or bad. As I'm fond of saying, nobody can predict what the market's going to do. Everybody tries. There's all kinds of channels, all kinds of people. Don't believe anyone on the internet, including me. But because check it out for yourself. But what they tell you, a market's going to go up or going to go down, don't believe them. They don't know. Because if they knew, they wouldn't tell you. They wouldn't tell me. They would keep it to themselves. And they would put all their money in. And in 6 weeks, they would have all the money because they know what's going to happen. They don't know, they can't know, and they'll never know. Okay? So all we care about is getting that slight edge, just like they do in casinos. You want to own the slot machine. You don't want to pull the slot machine. And those casino owners, they don't care if somebody wins or if somebody loses. They just care that there's lots and lots of bets because they know over time they're going to win. And that's the same thing we do. We want to do lots and lots and lots and lots of bets. Again, that's why the big players are going to have an advantage over you. There are smaller players. We want to bet as many times as we can. Small bets, bet small, bet often. It's not just a slogan, it's a lifestyle. Bet small, bet often. So the next one that we're going to put together, I'm going to show you how we set up the strategies and then how we deal with those as the day goes on. And that is an art into itself. But anyway, if you have any questions, put them in the comments below. We do read all the comments. If you're interested in getting Maria to do some more of these videos, just say more Maria in the comments below. Thanks a lot, and you have a great trading day. If I can get this off.